All right, let's now bring in that ex-Walmart exec who sees trouble lurking in the retailer's strong numbers. Bill Simons is a former Walmart U.S. CEO. He's now on the board of Darden Restaurants and other companies out there. Bill, in the pre-interview you did with our producer, Stephanie, you used the word bubble when it came to Walmart stock. Why did you choose that word?
Well, sure. First of all, it's good to be with you. And the conversation you're having, I think, is the right one. The trade down that Walmart's seeing from the affluent consumer into the business is not anything new. It happens every time there's an economic challenge, and we've seen it historically. Some of them stay and some of them go, and it'll be really interesting to see this time how many stay and how many leave. And it's a different company now with the digital capabilities that they have than it was the last time this happened. But the real issue is, and the challenge is that the tailwinds that have come from food inflation that have pushed Walmart along will reverse eventually. And we're starting to see some of that happen now. Those same tailwinds that drove the food business will become headwinds. And you'll sort of see a reversal between Walmart and Target. Target's breakdown of each of their categories is very similar to Walmart, but their overall business is impacted by the food general merchandise mix. And so as tailwinds shift to headwinds and vice versa, I think you're going to see some changes in the dynamic.
So at the crux of this use of the word bubble is the notion that what has been helping to drive its sales, which is the gain of the higher income consumer, some of those consumers will not stay. Why do you think they didn't stay in the past? It seems like it would be easier than ever to stay at this point because it's more of a digital commerce platform, and you can buy groceries and everything all at once. You can pick up in store, you can get it delivered. It's just a lot more convenient and easier to stay with that platform.
Well, I think that's really the difference between now and the last time that it's happened. Typically what happens is, when money's tight, people react, even high-end consumers react. The Walmart experience is better than it used to be, but it's still not, a premium experience. Walmart's built on convenience, cost, and assortment, not on service. And so as the economic challenges abate, and we all believe that they will eventually, service will become more important than convenience and price, and we'll see a shift back of some of the consumers. That's the
Bill, it's Tim. I'm sorry to interrupt. Yeah, and it's great having you here, because how about we drill in a little bit deeper into the stuff that you spent tons of years getting buried in, both formats and segments. So formats in the form of competition in different segments in terms of, say, private label, which is really picking up a lot of momentum. And the lower income consumer is actually spending more on private label, more inclined to spend on private label, especially at Walmart, where I think there's a pretty strong private label brand. Also at the expense of, in terms of formats, C-stores seem to be ones, we talked about grocery, that are really hurting here, especially with higher gas prices, higher prices there. Isn't this a reason why some of this is more sustainable for Walmart?
It is. It is to a certain extent, and kind of what you see is this shift in shoppers and formats. And I think you're exactly correct. That volume's got to be coming out of traditional grocers where pricing has gotten expensive, and Walmart really shines in that environment. The convenience channel, has historically had higher prices and higher margins, has the advantage of, for the most part, of having gas as a traffic draw, and so you see some of that business can tend to stick. The real challenge, and I think where Walmart has to really perform and continue to deliver, is to become that sort of digital bridge to try to keep those customers in. If those customers have to go to the physical box to get the savings, I think they're going to move. If Walmart can deliver a seamless experience digitally to them, many of them will likely stay. And that's really the challenge. That's what's different now.
Bill, you got a great view as to this, so I'm going to ask the question. View on inflation, and what are you doing if you're the Fed chair?
I'm still worried about inflation because I think that we're in a cycle of inflation. We saw cost components rise, which drove up, wholesale and then retail prices. Then we had a little bit of a lull. Then we saw these wage rate increases, where the UPS guys got a raise and the Delta pilots got a raise. Walmart, Target, all the retailers started talking about 15, 16, 18, $20 an hour. So we saw a rebound in wage rate increases. And when inflation sort of abated a bit, now with the wage rate increases, we're seeing more commodity pricing increases to compensate for the wage increases. And until that cycle stops, I'm still nervous. And I think the Fed will be cautious.
Do you think that cycle lasts for 12 months? Because you say that Walmart should be a great investment for 12 months, but then there'll be trouble, 24 months out. So is it the thesis that as long as there's inflation, Walmart, despite its valuation, will do well?
Yeah, I couldn't agree more. That's exactly right. As long as there's inflation and those tailwinds that come from, particularly from food inflation, more traffic will come to the Walmart store. And as you all said earlier, they'll not only buy groceries, but they'll buy the general merchandise assortment that, for the most part, they typically don't. Because they get the traffic from the food, they buy general merchandise. Walmart continues to do well. When inflation abates and service becomes more important than price, some of those tailwinds will become headwinds.